Kevin, thank you for joining us.
Thanks for having me.
All right, awesome. So further to our discussion on REITs, I thought it'd be a good idea to have you join us to help us to understand the topic a bit better. So as a start, I'd like to understand a little bit about the business model of Kingston Properties and then how that compares to what we know a REIT to be.
Yeah. Well, first thing let's talk about Kingston Properties. KP started out, as I keep saying repeatedly, we started out during the Great Recession in 2008 when a lot of people were particularly concerned about making any investment decision because of what was happening in terms of the collapse of a number of financial institutions in the States and the contagion effect of that globally. We started out by being a pure real estate investment company. At the time, we became the first pure real estate investment company listed on the Jamaica Stock Exchange. There were other entities that had real estate as part of their portfolios, but they weren't focused primarily on real estate. And our model is primarily this. We are an immediate cash flow generating real estate investment company, meaning that we seek out assets that are either currently cash flowing or very close to cash flowing, because we prioritize the receipt of cash so that we can pay dividends to our shareholders. So we are focused more on providing dividends and cash flows to our shareholders. The other aspect of our business that I'd like to focus on is that we focus on what we call the value add proposition. So we'd look at opportunities that are, perhaps need some sort of improvement to enhance value. Say a building that needs some upgrading, needs to be re-geared to attract new tenants. Once we've done those improvements and re-geared the property and attracted new tenants, obviously at higher rents, that's how we create value in those assets. And then the final thing about our model is that we are multi-jurisdictional. So that's one of the ways that we handle risk, because there are different types of risks in this kind of business. And we handle, say, geographic risk by having a dispersed portfolio in multiple jurisdictions. Currently, we are operating in Jamaica, the Cayman Islands, and in the US, and we're looking to expand into more territories.
All right, so how does your business model compare to what we may know a REIT to be?
So the main thing to focus on is in Jamaica, we do not have REIT legislation, which exists in many other jurisdictions. Exists in the US, in Canada, the UK, Australia. A number of other countries have REIT legislation. That doesn't exist here in Jamaica. Essentially, a REIT is a vehicle that was created, and they trace this back into they credit the creation of a REIT in the US in the early 60s. And that was a vehicle in which retail, very small investors, were able to participate in owning real estate assets without actually owning the asset outright. So if you think about, say, a large office building, which was probably worth, let's for argument's sake, was worth $50 million, most individuals would not be able to acquire that asset singly. So a REIT was a vehicle that was created that allowed multiple persons who would fit into the category of retail investors to participate in real estate ownership of that particular asset. So that's essentially what a REIT what a REIT is. But there were special features that were created around that as sort of incentives to get people to participate in the investment in those types of investment vehicles. And one of the biggest difference about REITs and jurisdictions that have REIT legislation as opposed to what we have existing here in Jamaica is that the taxation policy is different. For REITs, there is no tax on the REIT, so all their earnings are free of taxation, though the individual investors are subject to personal income tax, when they do their annual filings or whatever period they file their taxes. So that's the biggest difference that exists between, say, US REITs and what we have in Jamaica. There is no tax regime that governs REITs separately from, any other real estate investment vehicle, except, say, a unit trust.
is that something that you have been advocating for, that legislation that would, because what that sounds like is that it would add greater value to shareholders if you weren't subjected to that tax?
Yeah, this is a lobby that has been going on certainly from, as far back as maybe 2012, for us to have REIT legislation in Jamaica. Obviously, when it comes to matters of taxation, that goes through a much higher hurdle than many other things. So we will continue that lobby, because I do think there is a huge benefit in having more REITs, or more real estate investment companies, because it's a creative way of funding real estate investment. And I think it's something that should be encouraged, that more persons participate. And particularly, this is the vehicle for retail investors, persons who don't have the large sums of capital to acquire a large building or a large warehouse or anything like that. They can participate by having retail ownership in a vehicle such as a real estate investment company, a real estate investment trust, whatever name you want to call it, but something that provides that access to owning real estate for them.
So then the next question that I would ask you is, how does Kingston Properties differ from other real estate companies that are listed?
So I think the biggest difference would be in strategy. As I outlined, our strategy is immediate cash flow generation. There are some real estate investment companies listed on the exchange where they're more focused on development or greenfield projects. We have a fairly small percentage of our portfolio that is geared towards greenfield. The majority of our portfolio is geared towards the value add proposition, as I outlined before. Now, and that's an important thing for investors and prospective investors to look at. What strategy matches better with you. I mean, do you prefer to have more greenfield projects, or do you prefer to be generating more cash flows? Those are the kinds of decisions that people will have to make when they're making a decision about which one of the real estate investment companies to participate or to buy shares in.
Greenfield sounds more, I guess, to be a longer term strategy, because you said you prioritize cash flow. If you're investing in greenfield, that means it could take maybe 3 to 5 years to realize the benefits of that development.
Yeah, you're correct. That's why we focus on more immediate cash flow generating projects, just because it's quicker to cash as opposed to any sort of ground up greenfield development type project where you'd have to
Okay.
wait 18
Okay.
months on the shorter end up to.
And then there may be, potential delays that you don't foresee, and so those
And
projects
risks.
have a way of, yeah.
Construction risks is a bigger one, where your assumption about how things may actually flow in a project, may not end up being the way it actually happens once the project gets started. So, that could change your, whatever you had modeled as the return. So there are a number of risks involved when you look at greenfield projects. So, we tend to be a fairly conservative entity, and that's why we focus on, stuff that is already cash flowing, or, pretty close to cash flowing.
Okay. So I know, and I would assume that you have quite a comprehensive checklist for how you evaluate opportunities, but what would be maybe the top 2 or 3 things that you look for to identify an an opportunity, and what is maybe one thing that you absolutely make sure that the opportunity does not have, for you to decide on
Right.
that as a potential investment?
Right. I mean, real estate 101 is sort of matching risk and reward. If you are going to be getting into something of a particular risk level, then the reward must be there to justify it. We target investments that, from a net cash yield standpoint, generate us a return that is at least 200 basis points above our cost of borrowing. And our cost of borrowing varies depending on the jurisdiction. So that will determine the yield on the investment that we look at. So we look at that in the first instance. Does it meet all of because we do have a risk matrix. So there are a number of boxes that we have, at least 10 items that we need to check off. Some of those including what the yield is, what the IRR is on that particular property for, say, a whole period of 5 or 7 years. Is it likely to result in a decent uplift, and we do have a target percentage, which I won't disclose here, but we do have a target percentage uplift in the fair value of that property, within a 2-year cycle, or 2 years after acquisition, or 2 years after regearing of that property. We look at other things like the location of the investment. Is it located in a growing economy or a growing location? And by growing, we're talking about things such as jobs or population growth. Those are some of the key things that we look at. So we do have a long list of metrics that we look on, and we plug that into our risk reward matrix, and we have a scoring system, and that determines which one of the investments we will go forward with.
So I guess what you're doing is looking to see, of course, because you have to realize a return, cover expenses, and then return value to shareholders, essentially, right? So
Correct, correct,
has to
right.
be, if you're targeting X percentage dividend yield, then you have to be able to net that in cash to be able to distribute. Okay.
Correct. And one of the things that we've done fairly well over the last, 5-10 years is to manage our expenses. So if you look at our financials carefully, you would see that our net margin has been growing. For 2023, our net margin was just under 62%. Which, when you look at what the standard is for global REITs, or US REITs, because we do track performance of a composite of US REITs, they tend to be in the 49 to 50% region. So I think us being at almost 62%, I think it's a fairly good standard to keep. So if we're anywhere above 55%, I think we're doing well.
REITs, have you thought about maybe having uh, a dedicated, maybe subsidiary of Kingston Properties focused on maybe US investment opportunities? As that, I mean, I'm not really sure what that entails, but is that something that you've thought about?
Well, we do have disparate subsidiaries that hold properties in the different jurisdictions. I think if you're asking where people can actually participate in those specific subsidiaries as
Yes.
opposed to
Yes.
buying into the parent company, that option doesn't currently exist. It's I wouldn't say that's something that we wouldn't look at in the future, um, but certainly something to consider.
Okay. So you mentioned a couple of times the risk associated with this type of investment. What are, let's take it, I guess, more on a understanding of the real estate landscape, because I have this conversation quite a bit where I'm discussing with persons, investing in the stock market versus investing in real estate,
Mm.
right? So of course you can appreciate it. There are different types of investments, but what are some of the risks specifically for investing in real estate that you see? Again, just top two or three, and how do you specifically mitigate against those risks?
Yeah, it's interesting you should draw that comparison between the real estate market and the stock market, because there's an interesting thing about the perception of return. Um, both asset classes are really long-term asset classes, but there's some that feel that the return should be quicker for when you're dealing with stocks. And that some people tend not to be patient enough to wait on the returns that they might see on a real estate asset. So the first thing to get into people's consciousness is that a real estate investment is actually a long-term investment opportunity, and don't magically expect that you will see returns of 100%, like 2 days after buying a property, unless you were able to get it at some knockdown distressed asset, and you were able to regear it fairly quickly. But some of the main risks to look for is, the economic risk is one of the important ones, because in a growing economy, then obviously real estate is likely to do very well. Because let's look at it from a residential standpoint. If the economy is doing well, then the population is likely to be doing much better, and the population may also be growing. And if the population is growing, then there's going to be the need for housing. We have a limited amount of land. That's something that is not growing. So there'll be need for housing, and we know how the supply demand dynamics works. Not enough supply for rising demand is going to mean higher prices. On the commercial side, again, if the economy is doing well, then there's going to be the need for places of work. And places of work, whether it's office, and I know there's lots of conversation about the future of the office, but there is still strong demand for office space in and no, the demand is strongest for the type of office space. So you'd see greater demand for what is called Class A office space, which is office space with all the bells and whistles, completely turnkey, as opposed to some of the older types of offices that need some sort of upgrading. There's warehousing because people are demanding goods and services, and of course that is going to lead to the growth in commerce. And you'll see people moving into having more warehouses for storage of goods, that people consume. So we look at the economy as a main driver in the first instance. The other thing that we look at is the asset itself. Where is it located? Is that asset um, located in an area, specific area that is seeing re- what rebirth. I think that's more the term, or is that perpetually a deteriorating um, part of the market? Those are important things because that ultimately is going to drive price. So even though you may be in a growing economy, but if the specific location is not doing very well, then you could see some struggles in terms of generating higher fair values from that particular asset, or your rents could be much less than market than you'd like. You look at things like currency risk, interest rate risk. Most real estate transactions are conducted using financing, some type of financing, whether it's debt or equity. So let's say we're using debt as a financing. You have to look at interest rate risk, because if interest rates continue to rise, and that's going to obviously have an impact on what your net earnings are from that real estate investment. And if you're going with debt, some see it as a little less risk, but sometimes the cost of debt could be higher than your cost of borrowing. So a number of things that you have to factor in that. In our case, because we are a multi-jurisdictional real estate investment company that's based in Jamaica, currency risk is one of the things that we look at. When we took a decision back in 2019 to completely dollarize, to change our functional currency from Jamaican dollars to US dollars, because most of our leases were in US dollars and our financials are expressed in US dollars. So currency risk is an issue. So let's say, for argument's sake, you are in Jamaica, you're reporting in US dollars, and you have Jamaican dollar leases, then currency risk is a factor for you to take into consideration. Or let's say we had investments in Canada or in the UK, as well as we're looking at other territories. The movement of the exchange rate of those particular jurisdictions, let's say we had an investment in Canada and those leases are in Canadian dollars, we report in US dollars because we've changed the functional currency of our financials to US dollars from 2019. We'll always have to be looking at what the movement is between the Canadian dollar and the US dollar, because that can have an impact on the actual returns on that particular real estate property. Um, and there are a number of other risks, because we look at also y- the tenant base. You have to be very careful in terms of the selection of your tenants, because you could end up with a tenant who maybe has a bad track record elsewhere. So we do extensive due diligence on our tenants to ensure that they are not they are quality tenants. We're not likely to have delinquency in payment of rents, or any delays in paying rent, because that also can have an impact on your cash flows. And ultimately, if you end up in a situation of default, then that could mean significant write-downs. So doing proper evaluation of your tenants is an important part of how we do our business.
My final question really is, what do you see for the future of, I guess, the space that you're in? Because do you see, for example, future or different ways of investing in real estate, or Well, let me ask it this way then. Is there maybe a type of investing for real estate that you would envision that you'd love to see for the space? Let's probably ask it that way, because I think that may give me the type of insight I'm looking for. So let's go with that question.
Yeah, I think there's always going to be creativity in different ways of raising funding or financing projects. Certainly, at what one could consider at the micro level, there have always been some ways of creatively financing projects. You'll hear of persons, getting together and acquiring a property and developing that property, whether it's for their own use, let's say a residential property for their own use to reside in, or some have just used that, as investment property. So they let those spaces. So there is likely to be more creativity around funding real estate investments. We don't, as I mentioned before, we don't have REIT legislation. However, I think there are some avenues that persons, as I mentioned before, can use to creatively raise funding for real estate investments. Another thing that's as likely you could likely see is, like funds of funds types of things where, you'd have a fund manager who is look creates, say, a diversified portfolio of real estate investment companies. As I mentioned earlier in the conversation, that there are different companies with different strategies. So you could have a diversified portfolio where a manager acquires different types of these listed real estate companies, and creates a sort of like a fund of REITs, a fund of real estate investment companies, and offer that to the invested market. So, persons can get a little bit of each strategy, and, one works to balance the other. So those are some of the things. I do have hope that we will eventually get to a stage where there is REIT legislation and the tax benefits that are afforded to, things like unit trusts, are afforded to REITs. Because for example, in Australia, what they did was basically adapt the existing collective investment scheme regime that they had, which, collective investment schemes, unit trusts, same thing. They basically adapted that regime and included REITs in the umbrella group. So there wasn't any need to create any new sort of regime, new legislation, or new regulations at all. They just included REITs as part of the group of REITs. So I think it's a very simple process for us to get to that stage. And we will continue our lobby with the we'll continue our lobby to get the establishment of REITs in Jamaica, REIT legislation in Jamaica.
Right. Thank you so much, Kevin. I've learned so much, even though we've had multiple conversations in the past. Thank you so much for sharing. And
Anytime.
I'd love to see. I'd love to see. I think real estate does present certain opportunities. It's suited for a certain type of investor, and so it's a part of my personal portfolio. So I think it's something that we could do with more knowledge on. So thank you again for helping our audience to understand it.
Anytime, and a pleasure. And thank you again for offering us this platform to share more about not just KP, but real estate investment in general.
Thanks.